Welcome back to your ultimate pit stop, Piston Pundit. For decades, global energy markets followed a familiar script: Western financial systems, Western shipping lanes, and Western rules dictating how oil moved from wellhead to pump. But in late 2025, that playbook was stress-tested like never before. As Washington rolled out its most aggressive sanctions against Russia's oil giants and sharply escalated pressure on Venezuela, many assumed the chokehold would finally seize the system. Instead, the opposite happened. Moscow and Caracas didn't crack. They recalibrated, coordinated, and quietly rewired the machinery beneath the surface. The fallout is now rippling through fuel prices, shipping routes, and global supply chains. Here are the developments, the strategies, and the consequences you need to understand. Sanctions shock. Washington drops the financial hammer. When U.S. Treasury sanctions on Rosneft and Lukoil fully activated on November 21, 2025, this wasn't regulatory fine print. It was full-force economic pressure. Secondary sanctions meant any bank, shipper, or insurer touching Russian oil risked being cut off from the U.S. dollar system. In global trade terms, that's like running an engine without oil pressure, catastrophic if sustained. Initially, Washington's confidence seemed justified. Traders froze positions, tankers idled offshore, and refiners scrambled. Indian buyers rushed to load barrels ahead of the deadline, briefly inflating Russian exports before flows dropped sharply. Urals crude plunged to discounts exceeding $20 below Brent, hammering revenues. Equity markets responded fast, with Lukoil shares tumbling and Rosneft sliding despite Kremlin backing. Europe felt the mechanical backlash too. Bulgaria seized control of Lukoil's Burgas refinery to prevent fuel shortages, while Hungary sought exemptions. Brussels expanded sanctions on Russia's shadow fleet, expecting the squeeze to finally stall Moscow's oil machine. But while the sanctions looked sudden, Russia and Venezuela weren't scrambling, they were already moving. The Survival Pact. Moscow and Caracas defy isolation. What Washington underestimated was preparation. Russia and Venezuela weren't reacting in real time. They were executing a plan already bolted together. On November 12, 2025, just days before sanctions hit, both countries activated a broad strategic partnership spanning energy, mining, finance, transport, and technology. Calling it an oil deal undersells it. This was a long-term survival framework. Venezuela holds the world's largest proven oil reserves, but its extra-heavy crude needs diluents and technical expertise to move it all. Russia, seasoned by years of sanctions, brought exactly that, supplying over 100,000 barrels per day of naphtha and light crude to keep PDVSA exports alive. In return, Moscow gained a strategic foothold in the Western Hemisphere. This wasn't ideological, it was mechanical. Mutual dependency keeps both systems running. By 2025, 42 bilateral agreements locked in joint ventures, deeper OPEC plus coordination, and cooperation on minerals and transport. The message was simple: isolation fails when alternatives are engineered in advance. And that bilateral strategy didn't exist in a vacuum. It plugged directly into a larger protective block. Before we go further, do us a favor and hit that like button and subscribe to Piston Pundit. It helps us reach more auto enthusiasts and industry watchers just like you. Now, let's shift gears and move into the next layer of resistance. OPEC Plus as a shield. Sanctions meet organized resistance. OPEC Plus is often dismissed as a simple price management cartel, but by late 2025 it had clearly morphed into something far more strategic, especially for countries under sanctions pressure. Within the OPEC Plus framework, Russia and Venezuela can legally coordinate production levels, align public messaging, and project unity without triggering immediate retaliation. That institutional cover matters. The timing said everything. On November 2, 2025, just weeks before U.S. sanctions fully landed, OPEC Plus announced production adjustments framed as a move to manage market uncertainty. On paper, it sounded routine. In reality, it reinforced a crucial point. Russia was not isolated. but firmly embedded in a bloc controlling a sizable share of global oil supply. For Venezuela, OPEC Plus membership provided legitimacy, as Washington floated asset seizures like Citgo and escalated political pressure. For Russia, it offered diplomatic insulation and narrative leverage. Together, both avoided undercutting each other in Asia, preserving margins and influence. Sanctions didn't fracture the cartel, they tightened its internal discipline. But coordination alone isn't enough if oil can't physically reach buyers. Logistics had to adapt next. The Ghost Fleet, how sanctioned oil still moves. Sanctions can freeze bank accounts and scare off insurers, but they can't physically stop oil from moving everywhere. That gap is where the Ghost Fleet comes into play. Hundreds of aging tankers now operate beyond Western maritime systems, often flagged under jurisdictions willing to look the other way. These vessels routinely switch off transponders, conduct ship-to-ship transfers in international waters, and reroute cargoes mid-voyage to obscure their true origin. Paper trails become unreliable, ownership structures blur, and by the time crude reaches its final refinery, its identity has effectively disappeared. The European Union has tried to clamp down, blacklisting vessels and traders tied to this network, yet enforcement remains inconsistent. Even high-profile actions, such as U.S. seizures of Venezuelan crude or increased Caribbean patrols, have only caused temporary disruptions. Tankers reverse course, delivery schedules adjust, and alternative routes quickly emerge. The system is inefficient and risky, but it works. And those barrels don't vanish. They flow toward the fastest-growing source of demand. Asia's power grab, demand rewrites energy rules. While Washington and Brussels concentrate on enforcement, the biggest beneficiaries sit thousands of miles east. China, India, and a broader group of Asian economies have emerged as indispensable buyers in the new energy order, quietly reshaping leverage in global markets. Discounted Russian and Venezuelan crude keeps Asian refineries operating at high utilization while holding manufacturing costs down. That advantage cascades through the economy, supporting industrial output, export competitiveness, and even vehicle affordability at home. For automotive supply chains, cheaper energy directly lowers logistics expenses, steel and aluminum input costs, plastics production, and transport fuel prices. More importantly, Asia isn't just purchasing barrels, it's accumulating bargaining power. By positioning themselves as essential demand centers, these countries blunt the West's ability to weaponize energy flows. Power now belongs to those who control demand, and that shift brings us to the unavoidable conclusion. Verdict: sanctions built the system they can't control. What we're witnessing isn't just a tactical alliance between Russia and Venezuela. It's a structural shift in how the global economy absorbs pressure. US and EU sanctions remain potent tools, but their dominance is no longer absolute. Every escalation accelerates the rise of parallel systems, alternative shipping networks, non-Western finance, and demand centers beyond Atlantic control. For Russia and Venezuela, survival comes with compromises, steep discounts, higher logistical risk, and constrained investment. But isolation has failed. They're still selling barrels, still influencing supply, and still shaping price dynamics. For the West, the lesson is uncomfortable. Economic weapons can harden the very systems designed to bypass them. For the automotive world, the implications are massive. Energy costs dictate manufacturing margins, supply chain stability, and what ultimately rolls onto dealership lots. As energy power shifts east and sanctions lose bite, the rules governing mobility are being rewritten in real time. Before we wrap up, we want to hear from you. Do sanctions still work in a fragmented global economy? Is Asia now the real power broker in energy and automotive supply chains? And how do these shifts affect fuel prices, vehicle costs, and the future of mobility? Share your thoughts below. Your insights drive this channel forward. And don't forget to subscribe to Piston Pundit to get notified about our next vehicle updates and upcoming videos. Thanks for watching, and check out the videos on screen. There's plenty more to explore.